Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our fund manager interviews. With me today is Charles Heenan, who is the founder of Kennox Asset Management and the manager of their only fund, the Strategic Value Fund. Now, Charles, tell us a little about the fund. I know it's a value fund, and at MoneyWeek at the moment we're really interested in value investing, so we're particularly interested to hear about how the fund works and why you invest like you do.
Very good. So we are value investors. As you said, that means price matters. That's very important to say. We really do believe that if you pay too much for an asset, it's a huge risk. And right now, that's an especially big problem. We also believe in quality, though. If we can buy the highest quality assets, we think we're managing risk on another level. So,
okay, this is a bit like wanting to have your cake and eat it, wanting to buy high quality stuff at a very low price.
Which brings me on to the next point. We have 29 stocks, and our turnover is about 15%, which means we buy 1 to 2 stocks a year. And in the last year, I'm afraid to say we haven't bought a single stock. So what we're saying is it doesn't happen very often. And although it doesn't happen very often, it doesn't mean it doesn't happen. It just means you have to be patient. And we're firm believers that it's one of the hardest things to do is to not do anything, is to wait for the great opportunities. So
yeah, it's very unusual in fund managers. A lot of fund managers talk about being value investors, talk about waiting for opportunities, talk about patience, but when you look at their turnover, you find that actually inactivity is just too hard. They have to do something to justify their existence as an active manager.
Yes, I couldn't agree more. It's fascinating. We're having a good year this year. 2014, 2015 were not easy years for us. We faced the headwinds that a lot of value managers did.
Okay, let's talk about those headwinds. What were they?
Value manager was out of favor. It was fascinating. It's classic investment behavior, market behavior. People wanted things that had gone up.
So people just wanted to buy things that had gone up and were still going up. They didn't want to buy things that offered you value.
Anything that looked cheap, anything that had any problems with it, kept going down. A great example, Neopost is a little company which does franking machines. So we all know that Post is declining and that's a problem. Well, these guys are well positioned and they can manage that business for cash, and of course parcels are growing, so they can cross-sell into their 800,000 customers, small and middle-sized businesses. It's a lovely little business, but everyone was worried about it. Earnings were under pressure, et cetera, et cetera. We bought it on 10 times earnings and it went down to 6 times earnings. 10 times earnings, there are not many quality companies out there at 10 times earnings.
But you say these were bad years. Actually, they must have been brilliant years, because it's very hard for a value manager to find good opportunities, as you say yourself. But if value is out of fashion and prices are falling over 2 years, this is fantastic for you. Opportunities abound.
The relative or absolute, Merryn? Relative or absolute? This has been the problem. It's interesting. We a couple of other points on us on the fund. We have up to 20% cash, and that's all about conviction. If you're not finding, other things, other beefs we have with the industry, let's face it, if you trade 100 times a year, chances are you can probably find a buy and a sell on the same day. If you trade twice a year, what's the chances of finding a great high conviction buy and a great high conviction sell on the same day? I haven't done that. I've been in the industry for about 25 years now. I've never had the same high conviction sell and buy idea on the same day.
So you generally have quite a high percentage of cash. It's what at the moment, 15%?
It's 14. Yeah, so we're sitting around there. And the problem, our problem is that I think value has faced headwinds, and there are opportunities, and we think our opportunities are really exciting. I mean, our major concern is that in absolute terms, the markets don't look easy.
Let's talk, before we get on to the markets at the moment, let's talk a bit about what a value investment is. When you're looking for a stock, one of these 29 gems, what is it that makes you pick up one over another? What's the parameters?
So so talking about individual stocks, the first thing is we are long-term investors. So we are thinking on
a 10 year. What's the long term? 10 years.
10. Well, our turnover is, we say 15. It has been as low. Well, it's been under 10. So and certainly Jeff and I launched the fund in 2007. And half the stocks that were in the fund in 2007 are still in the fund now. So we have been holding things for 9 years, and that's the time frames we're thinking in. So first of all, get an idea of what quality you're getting over that time. Can you get any conviction whatsoever the company's going to be around in 10 years? IT is a great example. We can't. So we don't own IT. By your classic definition, is Google going to be around in 10 years? Is Microsoft going to be around in 10 years? maybe not. What does it all look like? We found it extraordinarily difficult to get conviction on a 10-year view. So then once you have an idea of what you think that company can earn, then it's fairly easy. What are you paying for it right now? And if you're getting that at a real discount, if you're getting that at a real margin of safety, well, for us, so we would look at a company when we're looking at companies. So we estimate, we spend an awfully long time trying to figure out what the 10-year earnings look like. I.e., is the company going to be around in 10 years, and can it earn any number, what it's earned in the past, say. And then you just decide, once you've got an idea, you say, roughly we think this company is earning X, and we pay up to 12 times that, and that's it. And why 12?
Okay, 12 times it. That's your number.
That's the number, is up to 12 times. And why 12? I mean, ideally, as I said with Neopost, we're probably paying 8 for Neopost right now, 7. That implies a really, really a strong, that's a 15% return plus. If you do 12, you're getting an implied return of high single digits, we're probably around 8.
Okay, so if you're ready to buy up to 12, when do you sell?
We find it very hard to hold anything over 20. So high teens, we get nervous, and off they go. Johnson & Johnson, great example. We like the high quality. In 2008, 2009, you're buying that, and the stock was around 50 or 60. It was below 60. A few years later, and everyone just said it's a dull company, it's too big, and it wasn't exciting. And you're getting that it was around 11 times earnings. It got up to 17, 18 times, and we're saying that's starting to get uncomfortable. It became one of the smaller positions in the portfolio, having been the biggest at one point. And then at some point you say, actually, now we just think it's time to go.
Not a value stock anymore.
Not a value stock anymore. Selling, the sell discipline, you have to trim as they rise, and that's definitely our discipline.
This is another discipline that's very, very hard for fund managers who start out as value fund managers, and their initial portfolio can very easily be a great value portfolio. But then 5 years later, of course, it's not anymore, but they've got to know the companies. They don't want to sell a company. It's still a really good company. It's just not, by definition, a value company anymore. But still they keep it, and then suddenly you find that portfolios morph. What started as a value portfolio is suddenly reinvented as a growth portfolio or as a quality portfolio, whatever it is. So it's another difficult discipline.
It's a discipline, and there's no questions about that. I mean, we struggle with that. We struggle with making sure that we're happy and not selling things too early, because we do believe that the trends go on much longer than we in the markets. We look at the markets every day, and you get excited, and this thing has gone up for 6 months. Well, isn't that exciting? Well, industrial cycles last 7 years, they say, and some of the investments, you look at some of the investments that a National Grid or an infrastructure or an oil company, they're making 40-year investments. I mean, these trends last longer than you think. So we don't want to have a high turnover. We don't want to sell them as soon as they go from 12 to 15. But we definitely bring them down. And there have been good examples of that. As we said, Johnson & Johnson, when you were around 11, we had that as the biggest stock 11 times, the biggest stock in the portfolio. At the end, when it was up at 18, 19, 20 times, that was a 2% holding. So it went from a 6% holding in the top of our down to a 2. And we've done that recently with Admiral, the car insurer here in the UK. A couple of years ago, 2 years ago now, they were having a tough time, the whole industry. We stuck that in as one of the biggest stocks in the portfolio almost immediately. It ran well, and it was a 6% position for us, and now we've taken out 3/4 of the position. It's back as a 3% position, so we've sold 3/4 of the shares we do. So we are value conscious, and maybe the last example there would be across the portfolio, we do look at these sustainable earnings, so it's not headline earnings, because we want to take as many anomalies out of it as possible and take into account the headwinds and tailwinds of cycles. But we're looking at our portfolio in 12 to 13 times what we see sustainable earnings, which to us, I would love it if it was 10. But in these markets, we still think that is giving you're getting paid to take that risk. And
let's talk about these markets. You're obviously worried about these markets. What's that about?
Okay, you need to take one thing into account, that I'm a permanent bear. I'm always pessimistic. I'm always convinced the world is going to end.
But history is on the side of the optimists, as someone said to me the other day. History is on the side of the optimists.
Well, that's true.
Being a bear is a mistake.
But the important thing is it's how you use your pessimism. So I use my pessimism as a tool, and I say, listen, I'm very nervous about the world, and I'm very nervous about anything, so this is how high my pessimism is. And so if I get an opportunity that's here, oh well, just have to let it. But if it gets to here, we buy. I mean, what we do is inherently optimistic, buying
so
equities.
what's the pessimism? Well, being in equities at all is an optimistic thing to be doing.
Exactly.
Obviously.
So I use my pessimism to make sure we have a high enough bar that the few things that get above it we think are really good opportunities.
So what's the pessimism based on?
So
I suspect MoneyWeek readers are going to know the answer to this, but let's hear your take.
I'll tell you that my pessimism is based on history. And history says that bad things happen. And if you can build a portfolio that you think can hold up, irrespective of what the bad things happen, you've done extraordinarily well. That's what equity investing is about. So if we can get them at reasonable valuations, imply good numbers, and we think that we have a real spread of businesses and diversification underlying themes in the portfolio, then that is extraordinarily powerful. What am I worried about?
Yeah, what are you worried about?
I mean,
start at the beginning of the list.
But it's classic. We wrote the last quarterly. I was just rereading it because we're writing the next one, and it was 2 days after Brexit, 6 days after Brexit, and saying we didn't predict Brexit, but we built a portfolio that was built for risks. It's built for storms, and so when that one came along, that one happened to work out very well for us, and we've done very well. So what am I worried about? President Trump for a start, but an oil shock again. Saudi Arabia, the Middle East is disintegrating. You can banking crisis, and today it just so happens that we're looking at Deutsche Bank, and the real question is Deutsche Bank going out of business? When clients start running away, when clients start pulling money, that's a run on the bank, and they go bust. Are we going to hit another banking crisis? And then there's the elephant in the room, of course, which is what are central banks doing? I know exactly what they're doing.
We know what they think they're doing.
But do we know what's going to happen? And we have no idea what's going to happen. So they say the future is always unpredictable. It feels especially unpredictable right now. And I think you know better than I do. There's no safe havens. Everyone. I was having a chat with an individual yesterday, and he was saying, we're all worried about risk, and we're all worried about how things are going to. I mean, we have to assume that you're losing 20% of your assets. I mean, I just don't see how you can, because you put the cash in the bank, and it turns out you put it in Deutsche Bank. So and that goes bust. So you can't, we can't. Risk is making sure that you have good savings for the long term, but risk cannot be, I have £1 million now, and I want to make sure I never drop below that. I never drop,
because that's simply not possible anymore.
Because it's not possible. The risks are too high. You look at the assets, and it's just impossible to see how all the assets.
So all readers should assume that at some point over the next, say, 5 years, 10 years, their wealth will drop by 20%.
I think on average, I think that's fair. Can you tell I'm a pessimist, Merryn?
Yeah, I'm digging around for the optimism.
But what I do is go buy stocks, and that's the most optimistic thing you can do, because you are buying an unlimited duration asset. We hope.
Okay, well let's move on to the optimism.
Where are the opportunities?
Yeah, what's in the portfolio at the moment?
Maybe the end of portfolio, the end of asset allocation is make sure you're diversified. We just don't know. Bonds look horrific, but in deflationary times they can work out. Having some cash makes sense.
Yeah.
Don't put it all in one bank. We believe certainly that having a bit of gold makes sense, and equities. Long-term assets. Have some property.
Are there any gold companies in your portfolio?
It's the biggest stock in the portfolio.
Yeah, which one? Which
hurt us a lot. Talking about why 2014 and 2015 weren't easy. Those were obviously tough times for it as they bounced along the bottom, and then 2016 running through the roof. Newmont is the biggest stock in the portfolio. So we talk about quality. What we do is we often look for areas that are having a tougher time. And then you pick the highest quality ones.
Yeah, but the gold miners have now had a fabulous run this year.
They've had a fabulous run.
But that's still a value stock, is it? You wonder? hasn't made the turn yet.
It hasn't made the turn yet. No, I mean we've taken about 20% off, but that was, our big holdings tend to be between 4 and 5%. It was 5% at the beginning of the year. Obviously, it's done extraordinarily well, and now sits about 7%. But that's that means we've still taken 25% of the.
So what's the case for it continuing to work on the air?
So the wonderful thing is talking about how long themes take to play out, and if you look at the world, there is oversupply. Even though we hear a lot about, are we investing enough? Are we investing enough? Are we investing enough? And probably the companies aren't investing massive amounts, but at the same time, they've taken out almost no capacity. Everyone's added just incrementally. They haven't grown as fast as they used to. But if you look across the whole, very few industries you look at where you actually have seen supply shrink. And so what happens? That's just a risk.
But that is one of the consequences of cheap money, right?
Exactly. Yeah, I think it's quantitative easing and also the psychology of the markets. The markets are desperate to, everyone's got too much money and they're desperate to support whatever it can. So you're ruining the economics of many industries. So one little downturn in demand, and it absolutely destroys it. Swatch is one. I don't know if you've ever looked at Swatch. Swatch is a fascinating company. It's all 50% from the top, so we get interested as value investors. Hit about 600, and now it's below 3 in Swiss francs. But they're swimming in oversupply in that industry, and demand is turning down a little bit.
Interesting. There's definitely I was in Switzerland the other day, and someone gave me a Swatch.
Huge piles of them, handing them out to everybody. So clearly oversupply.
So Swatch is an interesting company because they have the cheap plastic ones, but they also have the brands right at the top. So the ones where they're charging you £20,000 to £30,000 per watch. I don't understand. I wear a £100 watch. It's 15 years old.
£59.
This is depreciated over time. Over 15 years, it's a bargain. But obviously it has some appeal. But it's just fascinating. The oversupply continues in that industry, and the downturn in demand, and it really is hurting it. So look all the way around the world. What's the one? What's the best industry in the world in that? Gold.
Even one of the very few industries where there is not oversupply.
Where the supply is coming off. So it's not, it is, where there is not oversupply, but also that you're seeing that what has been a headwind turn into a tailwind. Shipping is the other interesting one, but we can come on to that.
It's interesting, but will all the ships be taken out of mission? It seems unlikely that oversupply will go.
It's far too early. Whereas gold, actually, we're 4 years into it. The gold price peaked in August 2011, so we're 5 years into it. But the actual peak in capex, because of course the cycles take longer. You look at we track the capex of all the major players. It peaked, of course, the year after. They don't stop things immediately. They continue to believe that it's going to be good. So it didn't peak to to December 2012. And supply started to shrink in the fourth quarter of 2015. So it took
a while.
Another 3 years, and we're only really starting to see that come off. So what has been a huge headwind for that industry is now turning into a tailwind, and it's one of the very few in the world. So.
Interesting. So you watch the capital cycle at the same time. Yeah. And are you watching that for the rest of the commodity sector? Everything else is still in oversupply. Yeah.
And
when will that turn, the capital cycle for the rest of the big miners, etc.? What's that, 2 years away?
We think it's too early still. That's why we don't own any of those. We don't own the BHPs, the Rios. Antofagasta, I think, is a brilliant company. Really a lovely, lovely asset. It does copper, for those of you who don't follow it, copper alone. It still looks too early to us. It still looks like we've got another year to 2 years. And we love to say, we long-term investors, we're going to jump in 2 years early. You try and minimize that, because the blow-offs at the end can be very painful as the thing. So we really are, from everything we've been looking at, we found it very tough to get conviction on those ones.
What about big oil? When we talked the other day, you said that was looking interesting.
Well, the energy is fascinating because again, you're looking at where are some of the very few places in the world where you've seen the supply getting absolutely decimated. And I mean, we've seen estimates up to $2 trillion of projects being cancelled. We don't know when that's going to affect the oil price, but we know that BP and Shell and Exxons of this world will be around to see it. And on a 1 year view, we're still quite bearish. There was the OPEC announcement just yesterday. Everyone's very excited about oil today. It looks flimsy. On the short term, I don't buy it. But on a 5 year and a 10 year view, we're still convinced that those guys will survive, and you just can't decimate that industry like that.
Are they in the portfolio? Are they in the portfolio?
About 15% of the portfolio is in that. So gold is between Newmont and a smaller holding we have is about 9.
What's the smaller holding?
Yamana. is a little, it's a Canadian listed one, so we have a small holding in that one. It's a low cost producer, but it is riskier. It ends up it's got more mine risk, specific mine risk, and it's in Latin America and less safe jurisdictions. Newmont, if you're looking for the blue chip safe one, which we all the quality, it operates essentially in North America and Australia, so you're very safe jurisdictions. They don't have any of the single mine risk. A lot of the bigger companies, Newcrest for instance, has an awful lot. They have very low cost of production, but it's all in one mine. So if that one mine goes wrong, you're just bearing a risk, and we're not going to predict when those mines go wrong. So, and then Newmont's also a low-cost producer. So that for us, that makes Newmont a very easy one. In energy, yes, we do. We own BP, Shell, Exxon, and in fact Statoil as well. And we just think that there's the opportunity for the bigger players to be there is very attractive. As always, build it inside a portfolio. We wouldn't go punting on it, but we think inside a portfolio on a 10-year view. These things, they're the survivors in one of the very few industries in the world where you're seeing supply absolutely getting hammered right now.
What about the banking sector? Would you ever see value there? I was speaking of, when I was given the free swatch the other day, I was at a conference in Geneva, and we were discussing the extent to which the big banks of today will be with us in their current form in 10 years, or will they really be more or less irrelevant as a result of all the regulation changing their business models, and as a result of all the new businesses coming up, nipping away at this business, that business, this business, and what's left in 10 years. But if you look at the prices and you assume a long-term survival, maybe there would be value. I don't think so, by the way. But
well done. Leading question. A lot of value investors are looking at the big. There's a couple of areas where that look outright cheap, and banks are one of them. Tech is one as well. A lot of guys are in tech because if you take all the cash pile out of Apple, it's on 10 times earnings, isn't it? Well, we have no idea what the sustainable earnings are for Apple, so I don't really care about the cash pile. We just can't buy that. We just have no view on what it's going to look like in 10 years' time. My guess is there's going to be another product that we like better in 10 years' time than we like Apple. The same way it was Nokia, and before that it was Motorola, and before that it was the dial phone.
That could be true of Commerzbank or Lloyds or whatever as well, and that it may be that in 10 years there are other financial products that are better for us than the ones being offered by banks at the moment. I
know a lot of people who say that they're just sitting ducks, that they will lose their best customers and they get left with the drag. Merryn, just the quick answer to your one is we wrote a paper this summer saying why we will never own banks, and at one point in the cycle they're bust.
Yeah.
And we just don't want to have to predict. And Deutsche Bank looks like possibly today. But at one point in the cycle, they're bust. And we just don't want to have to make that timing prediction of when they're going to be bust. So we really struggle to see how banks will ever be the right thing for us. And that's fine. It's a big world out there. We only need to find 25 to 30 stocks. And if we find the right ones, then we don't have to worry about the ones we miss. So we're fairly happy to leave banks to someone else, people who are much cleverer than us.
So it's a great fund manager thing to say. I just concentrate on the simple stuff. I leave everything else to clever people, by which they mean stupid people.
I don't know. You keep it simple. A few big things is better to know than lots and lots of. You don't want to make it too complicated. If you can keep it simple and stick to your discipline. But as you said at the beginning of this interview, one of the hardest things is to do nothing. It's incredibly difficult, especially when times are a little bit tough.
And difficult to explain to clients paying you 1% a year as well. We haven't done anything this year.
What, sorry?
We haven't done anything this year, but we're still taking 1%.
You pay for that is there are some clients who don't understand that.
But they're paying for strength of character.
That's the fund is performing extraordinarily well because of what we did before, and what I think it's important for clients who buy funds to how long are you intending to hold this fund for, and a lot of you want to hold them for a decade. Then a lot of the time I think the fund manager should be doing very little, making sure that what goes in is very, very high quality and then sticking to it.
Okay, well, We've got a lot of commodities so far. What else is in the portfolio?
Well, and then you
what else is really interesting?
Yeah, the other one, I mean, I mentioned Neopost at the beginning.
Yeah.
We do love our stock-specific risk. That's a franking machine. That's a duopoly. There's only two of them. You're getting paid a lovely, lovely price, and it's completely different to what we've talked about. Western Union is a fascinating company. It's still on about 11 times earnings, generates brilliant cash flow, and that is the remittance business. It is about sending money from here to there, and there's technology risk. Yes, there's risk. We bear risk all over the place. But if we can build a portfolio that has some commodities in it, some very specific, the energy and the golds, but then mix it with things like Neopost and Western Union, we're completely differentiated.
Neopost and Western Union.
Western Union, yeah, the remittance business. Also, we do. There's been a few of our favorites in Japan. Recently, one that's been doing well is one called Taisho Pharmaceuticals. Call it a Japanese GSK, Glaxo. So they've got the consumer health as well as the pure pharma. And they're one of their key products. On their pharmaceuticals, they have osteoporosis. Obviously, that's going quite well in Japan right now. They've got antibiotic that's done them extraordinarily well. But they also have what is seen as the health drink, the energy drink for old people. It's called Lipovitan, and it's got a 50-year history, and it's got about a 40% market share.
And what's in it?
It's healthy things, mostly ginseng and those sorts of natural Asian roots and things like that. And it's seen as very healthy, so I don't think it's going to hurt anyone. And
this is interesting because a lot of value investors now starting to look in Japan, which 10, 15 years ago you wouldn't have found a value person anywhere near Japan, but
yeah.
Now it's beginning to happen.
Well,
is that because people are beginning to notice that Japanese companies are often very cheap and have huge amounts of cash on their balance sheet, etc.? Is that what it is?
I hope the value managers were there a few years ago, because 3 years ago, all our screens were 80% Japan, and we made a risk decision there. We said we didn't think it was appropriate to have more than 20%. Because we were worried about the demographics, we were worried about the political system, we were worried about the banking system. And also about the corporate governance. We were saying, will we ever get the money? Now, our companies are traditional Japanese companies.
But corporate governance in Japan is improving.
And that's why
great leaps at the moment.
And that's why the share prices have gone up so much. Okay. 3 years ago, all our stocks were half of what they were now, and we had 20%. It's now doubled, and we're down at about 15%. Yeah, 1.5. And again, what we've done there, Merryn? Nothing. We bought the companies 3 years ago, and we've done nothing new. We've been trimming them. We've been bringing them back as they've run. But still, our average company has about 50% of the market cap in cash now. So we're desperately hoping these glimmers of daylight on the corporate governance side in Japan are starting to come through, because our portfolio would be very, very well positioned there. Japanese, they always say, and you know it better, but better than I would. But Japanese, they always say it takes a long time to build consensus. But as soon as you build consensus, they move very quickly.
Well,
and that's what
that appears to be happening right now in the corporate governance space.
We hope so, but we hope so. But we're not gonna. We don't need to bet on it. We're doing very, very happy with holdings.
I'm gonna let you go on the condition that I know this is like having a favourite child, and that's not allowed. But you've got a favourite stock. One to hold for 10 years from that portfolio. Which one would it be?
You should never do that, because it's always risk in building a portfolio, et cetera, et cetera. But a year ago, I know I would pick 4 or 5, but I'm going to play your game. I'll play by your rules, and I'm not going to give you 5. I'd stick with Newmont.
Would you?
Yeah, I still think the gold sector, the gold sector has all those fundamentals that really, really help. And what's especially nice is we live in crazy times. The world is crazy right now, and to have something that is properly diversified, and that in the form of Newmont is, a reserve of gold sitting in the ground, and I think is very attractive. So, it's the biggest stock in the portfolio. We're pretty happy that it's still a good place to be.
Okay, brilliant. Thank you very much.
Nice to see you, Merryn.